For private limited companies, here they say there is one essential difference between a company and an unincorporated business, such as a sole trader or partnership. A company is a separate legal unit from its owner. It is an incorporated business. This means that a company exists separately from the owners and will continue to exist. If one of the owners should die. So, a private limited company is more like an incorporated business. Why? Because it has its own legal identity, separated from the owners of the business. That's what the point is about. Do you get it?
Yes.
Like sole trader partnership, they are unincorporated business. So they don't have legal identity separated from the owners of their business. So the business is the same as the owners. That is unincorporated. But if it becomes incorporated, it means it has its own identity separated from the owner.
Yes.
So a company can make contracts or legal agreements. So that means a company can sue or be sued. A company can sue you, or someone can sue the company because the company is separated.
Is it not like the sole trader? I mean, sole trader cannot do that.
If you are suing a sole trader, you are suing the owner.
Even the partnership, right?
Yeah.
Oh, okay.
Do you get it?
Yes.
So companies are jointly owned by the people who have invested in the business. These people buy shares in the company and they therefore called shareholders. So these are shareholders, people that have investment into the business. They have shares with the business. These shareholders appoint directors to run the business. So they have directors which are appointed by the shareholders to run the business because the shareholders are the owners of the business. The directors are usually the most important or majority shareholders. This is usually not in the case of a public limited company, as we shall see in the next section. So for a private limited company, the owners are also the directors.
Yes.
Do you get it? But amongst them, they choose the directors. But private limited company is run by friends and family, not like a public limited company. Do you understand? Do you get my point here? A private limited company, doesn't sell shares to the public. Shares are sold within friends and family. So logically, we're talking about a business like a family business run by family or friends that they know. But it's a company, it's incorporated, not partnership, not sole trader.
Yes.
So why do they run such company? They run such companies so that they can have a separate identity from the business.
So it can be in the future and run in the future.
And it can continue to run, can continue to be in existence even in the future.
Yes.
So go to the advantages of a private limited company. Shares can be sold to a large number of people. In some countries, there's a maximum number. So these would be likely to be friends or relatives. So shares are sold to friends and family. You cannot sell to other people. You can't sell to the public. You only sell shares among your friends and family that you know each other. That's an advantage. That means you know yourself, you know them and they know you. Mm-hmm. 2, all shares have limited liability. All shareholders have limited liability. So the death of the business does not affect the owners of the business.
Affect the business only.
The owners of the business would only lose their investment, not their personal wealth. So whatever they've invested into the business might go with the death of the business, but they won't lose their personal wealth into the business. Is it clear?
Yes.
The people who started the company, are able to keep control of it as long as they do not sell too many shares to other people. So another advantage is that because you are selling shares between friends and family, you're not selling large number, you're not selling to the public. So you won't lose control of the business. This frequently happens with public limited companies because you don't even know who has your shares. But in a private limited company, you can monitor those who buy the shares because they are all friends and family. So the owners of the business will not lose control of the business. Is it clear?
Yes.
Then what are the problems of private limited company? 1, they said there are significant legal matters which have to be dealt with before a company can be formed. In particular, 2 important forms of documents have to be sent to the registrar of companies. We have the memorandum of association and the article of association. You have to send these 2 documents to the registrar before you can be incorporated. And these are paperwork. So we talk about the articles of association. This contains the rules under the company will be managed, which under the company will be managed, the rights and duties of all directors, rules concerning the election of directors and the holding of official meetings, and the procedure to be followed by issuing of shares. So for article of association, it talks about how the company will be managed, the details about the directors of the company, how they will be appointing new directors. Everything will be detailed in the articles of association. Is it clear? Then we have the memorandum of association, the MOA. This contains very important information about the company and the directors, the official name of the company, the address of the company, and the objectives of the company will be stated in the memorandum of association. Do you get the difference here?
The first one talks about directors and duties.
The rights and duties of directors.
Okay.
What the directors can do.
Okay, and the second one.
The second one talks about the profile of the directors, who they are, their qualifications, what the
So one talks about what the purpose of the director.
what they can do.
Yeah, what they can
The
do.
other one talks about their profile.
Yes.
Is it clear?
Yes.
So both of these documents are intended to make sure that companies are correctly run and to reassure shareholders about the purpose and structure of the company. Once these documents have been received by the Register of Companies, a certificate of incorporation will be issued to allow the company to start trading. So as soon as a certificate of incorporation has been accepted, then has been given, then you can start operations. But before you get that, it takes a long time. Do you understand?
You have to approve it, right?
The registrar of companies must.
Yeah. So it takes time.
Yeah, it's from the government. They have to accept, they have to approve that your business is able to become a company.
And then you can operate.
Then you can operate.
Yes.
The shares in the private limited company cannot be sold or transferred to anyone else without the agreement of other shareholders. So another problem about private limited company is that if one partner does not accept or agree that others should sell, if one shareholder does not agree or accept that others should sell their shares, they cannot. They all have to agree to transfer or to sell shares. Do you get the point here? But for public limited companies, it's not like that. You could sell your shares to anybody you feel like, at even any price you want to. Nobody knows about it. But in private limited companies, share selling is monitored. The movement of shares is monitored. That's the point.
Yes.
The accounts of a company are less secret than for either a sole trader or a partnership. So each year, the latest accounts must be sent to the register of companies and members of the public can inspect them. So another problem is that there's no secrecy, unlike the partnership and sole trader. Here, you have to publish your account.
Yes.
And people could have access to it.
And even the statement of financial position.
Yeah, that's the account we're talking about.
Yeah.
Is it clear?
Yes.
Most importantly, for rapidly expanding businesses, the company cannot offer its shares to the general public. Therefore, it will not be possible to raise large sums of capital to invest back into the business. So the last problem about a private limited company is that the amount of capital injected into the business is still limited because you have limited numbers of shareholders. You can't sell your shares to the public. It is only when you can sell your shares to the public that you can have more money from the public. But here you can only sell to friends and family. So that means the amount of capital available is limited to the amount of capital contributed, the amount of shares bought or sold by friends and family. Is it clear?
Yes.
So that's all about private limited companies.
It's about the
Yes.
company.
Yes.
Even sole traders have to release or not establish, give the statement of financial position, right?
Yeah, to the tax office.
Only.
Yes.
Okay, how does companies compare, competitors compare with the sole trader, with the statement of financial?
No, they can't. Sole traders, no.
Even partnership.
Partnership, you can't. They get income tax.
Yeah.
They pay income tax like what you pay. So who knows what you get? Who knows your salary? Nobody knows.
So it's income tax for sole traders.
Sole traders and partnership, they are charged income tax, not corporate tax. But for private for limited companies, they are charged corporate tax.
Yeah.
Is it clear now?
Yes.
Okay.